Hi friends, there is a lot of noise about Indian economy. On one hand, people like Donald Trump are saying that India is a dead economy. On the other hand, global institutions, large corporates and big investors are saying that India remains a long-term growth story. So in this video, I'm going to discuss 5 extremely critical points about Indian economy. Point 1 is Indian economy dying? Point number 2, the biggest problem of our $4 trillion economy that we face today. Point number 3, why people call India a long-term structural growth story. Point number 4, impact of tariffs on Indian GDP. And point number 5, can India really grow from $4 trillion economy to $18 trillion economy by 2040? And the reason we are trying to understand this macroeconomics is that if you invest in stocks, mutual funds or capital markets, then you need to understand what's happening with Indian economy because the returns are typically pegged to the Indian economy's growth. Let's start with point number 1. Is India a dead economy or a dying economy? Have a look at this data here on my screen. This is not my data. This is a data from IMF. And what you need to focus here is on the black bars. These black bars represent what percentage of world's GDP is coming from India. So for example, in 1990s, it used to be only 3.6%. It has grown to almost 7.8% by 2024, meaning 7.4% of world's GDP is coming from India. And this is likely to further grow to 9.2% by the end of 2030. More importantly, focus on the green bars. These green bars are showing what percentage of world's GDP growth rate is coming from India. So for example, in 1990s, 6.6% of growth rate of world's GDP came from India's GDP growth rate. Here in 2024, it has gone up to 15.8%. And by 2030, it is further likely to grow up to 19.2%. This simply means that if world's GDP grows by 100%, India has contributed 19% into that growth. Now, if you go to IMF's website, what you will find is the latest data. India is officially 4th largest economy in the world. More importantly, if you go back and have a look at this chart here, you will note that for the last 40 years, Indian economy has been growing between 6 to 8% consistently. Also, if you compare this with other fastest growing economies and world's largest economies, you would note that India has been the second largest economy growing at a very, very rapid rate after China. Green line here is the China's growth rate and brown line here that you see is India's growth rate. In fact, if you look at since 2020, India has taken over China when it comes to GDP growth rate. So these are the facts, and these facts tells us that India is definitely not a dying economy. In fact, it is forecasted that a huge portion of world's GDP is going to come from India. So Trump or anyone else calling Indian economy a dying economy or a dead economy is total madness, 24-karat madness. Having said this, let's move to point number 2, which is what is the biggest problem of Indian economy right now? And that is GDP per capita. What is GDP per capita? We simply take the GDP of a country and divide it by the population of that country. Right now, if you look at the GDP per capita of India, it is at around $2,800 per capita. In rupees terms, it comes out to be around 2,50,000 rupees. Although India is the 4th largest economy by the GDP, but if you look at the GDP per capita, India ranks at around 143. This is far, far way down the list. So why does this matter? This matters because there is a strong correlation between GDP per capita and the happiness of a country. For example, if you look at the top 10 countries by GDP per capita, for example, Luxembourg, Ireland, Switzerland, Singapore, Iceland, Norway, United States, you will find these top 10 countries in also the list, which is the top 10 countries by the happiness rank. For example, Finland, Denmark, Iceland, these countries are also very high when it comes to GDP per capita. Also, it's very important for us to understand the per capita GDP's growth rate. If I take you back to 1990s, our GDP per capita used to be around $368. Since then, it has gone up to almost 2,800 by 2025. So it has multiplied by almost 8 times. But have a look at other countries. For example, Poland, 1990s, their per capita GDP used to be around $1,600 and it has gone up from $1,600 to almost $26,000. It means it has multiplied by almost 15 times in the same period. Also have a look at China. 1990s, their GDP per capita used to be very similar to India at around $347. But in the same period, it has gone up to almost 13,000 US dollars, which comes out to be almost 40 times multiplication, which simply means that they have multiplied their GDP per capita by 40 times in the same period versus India that has gone up by almost 8 times. So this is definitely one area where India as a country has not done well, and we need to accept it, we need to acknowledge it. We need to improve on GDP per capita, and this is important. Why? Because if we want to be a developed country by 2047, as per World Bank's definition of developed country, a developed country is classified to be a high income generating country, and for this the qualification criteria is that per capita gross income needs to be more than $14,000 per year. So for India to be a developed country by 2047, our GDP per capita needs to grow somewhere between 7 to 8%. Can we actually grow our GDP per capita by 7 to 8% for the next 15 to 20 years or so? For this, let's move to point number 3. Why people believe in India's long-term growth story for the next 15 to 20 years. The reason people believe in India's long-term structural growth story is because of very, very good macroeconomic factors. Let me walk you through few of these. For example, number 1 is fiscal deficit. Fiscal deficit is simply Indian government's revenues minus the expenditure. We have had higher expenditure than the revenue for a number of years so far. And that's why we are in a fiscal deficit. We are not in a fiscal surplus. We are in a fiscal deficit. But if you look at the fiscal deficit data, it has come down consistently in the last 3 years. It used to be at around 6.4% back in 2022. It has consistently come down to almost 4.8% as per the revised estimate for 24-25 fiscal year that has just closed. And the projection is that for the next year, which is 25-26, it is likely to go further down to 4.4% of the GDP. Now, if you compare this data with, for example, US, they are sitting at a fiscal deficit of around 6.2%, which is much higher than India. And if you also compare this with China, they are sitting at even much higher fiscal deficit of at around 8.8% as of 2025 forecast. And this is very, very important data point, because if your fiscal deficit is low, then you are not borrowing much money. As a country, your debt requirements are diminishing, and therefore you are able to spend more money on development. With that, let's move to factor number 2, which is the debt to GDP ratio, extremely important data point. So India's current debt to GDP ratio is running at around 57%, and it is likely to come down to 56% by the next year, 25-26. Compare this with countries like US, who are sitting at a huge debt pile. In 2025, US debt has surpassed 37 trillion US dollars, and to put this into debt to GDP ratio, it has crossed easily more than 120%. India is sitting at around 57%. Now, what a high debt to GDP ratio does to a country is what is happening in US right now. They're spending more money on interest to serve this debt versus spending money on, for example, critical operations like defense or, for example, Medicare. Have a look at this data. In 2024, they spent around 13% of their total expenditure to just pay the interest, which is much, much higher than the Medicare as well as defense. So definitely having a lower debt to GDP ratio allows a country to spend more on development. For example, if I talk about India's development, if you look at the PLI scheme alone, India has spent around 1.61 lakh crores on PLI schemes across 14 critical sectors. You might have heard about PLI schemes, for example, for semiconductor sector, for example, electronics manufacturing sector, and various other sectors where government is able to spend money on PLI schemes. Why? Mainly because our debt to GDP ratio is lower than many other countries, and therefore we are paying relatively less money to interest, and therefore we can afford to spend more money on development. Third parameter is inflation data. Have a look at my screen, and what you note is that consumer price index CPI inflation data as of May 2025 has come down to 2.82%. If you go back to history of India's inflation, you would find that we have been sitting at around 5% average inflation rate. It is much, much lower than the average inflation rate. It is now below 3%, and for an economy, if your inflation rate is down, you will have better economic growth. Fourth quick parameter that I want to quickly speak about is foreign exchange reserves. Our forex reserves as of June 2025 stands at around $100 billion. These reserves are going to be very, very handy because if India's exports slows down for whatever reason, we'll talk about tariffs in a minute, but for whatever reason, if the export slows down, we are still able to import for at least 11 months. Even if we have zero exports, this is the power of the forex reserves, and we are sitting at around 700 billion US dollars. Secondly, these foreign reserves also help RBI protect our currency. If the currency starts to devalue at a very, very high rate, RBI can intervene and they can protect Indian currency. Moving on to point number 4, which is the impact of tariffs on India's growth story. If you look at this report that came out from S&P just yesterday, it says that US tariffs are not likely to impact India's growth. The outlook by S&P remains exactly same as it was before US tariffs. But even if we dig deeper and talk about specific numbers, have a look at this screen here. Here, around $8.1 billion of exports may get impacted. Please understand that all the US tariffs that we are talking about are not going to impact entire 100% of the exports. For example, pharma is out of tariffs. And as per this study, around 0.19% of India's GDP might see a hit because of 25% tariff announcement. The remaining 25% of the tariffs are going to be levied from 26th or 27th of August onwards, and there has to be negotiations prior to that. So in my view, tariffs are a short-term threat. They are not a long-term threat to India's growth story. With this, let's move to point number 5. Point number 5 is all about, can India's economy or GDP grow from current levels of $4 trillion to almost $18 trillion by 2040. For this, have a look at my screen, and McKinsey has recently published a beautiful report. And as per this report, India can hit 14 to $18 trillion of GDP by 2040. Provided India concentrate on 18 high growth dynamic arenas. Arenas are nothing but they are transformed sectors and are characterized by 3 important points. Number 1, step change in technology or the business model. Number 2, sustained investment dynamics. And number 3, large and growing addressable market. So what are these 18 high growth arenas? There are 9 global arenas and 9 local arenas. Let me walk you through global arenas first. For example, number 1 is e-commerce. 60 to $70 billion were contributed by e-commerce as of 2023, and it has a potential to grow up to $240 to $300 billion. Secondly, semiconductors only contributing $40 to $45 billion by 2023 and has the potential to grow up to $100 to $120 billion by 2030. Likewise, cloud services, cybersecurity, EVs and batteries, AI software and services, space, nuclear fission and robotics. These are the 9 global arenas that McKinsey has identified. When it comes to local arenas or national arenas, number 1 is urban construction. It can grow up to $400 to $490 billion by 2030. Number 2, travel and tourism can go up to $360 to $420 billion by 2030. Likewise, auto components, renewable with storage systems, aerospace and defense, bio, medical devices, biopharma, industrial electronics. These are some of the national arenas that can pump huge growth to Indian economy. And these 18 high growth arenas have the potential to generate between $1.7 trillion to $2 trillion by end of 2030. So when it comes to India's GDP growth by 2040 or the growth of capital markets, I'm an optimist. Of course, I do recognize that there are challenges, there are gaps, there are hurdles. For example, we talked about per capita GDP in our country. What is your view about India's growth by 2040? What do you think are the challenges that we are facing right now? Let me know in the comments. If you like this video, share it with your friends. Press the like button. Let me know in the comments a simple thank you. It motivates me to curate content for you at zero cost. Also, if you want to learn about stock market, mutual funds, you can consider joining my YouTube community. I post almost on a daily basis. You are going to learn a lot practically almost on a daily basis. The feedback of this community has been excellent. Simply go to my channel, find the join button and be my guest. With that, I hope to see you in my next video. Until then, keep rocking.